Stop everything and listen carefully. While mainstream financial media remains silent, something extraordinary is unfolding in the silver market that could reshape global supply chains and investment portfolios forever. In early January 2026, the COMEX Silver Exchange experienced what analysts are calling an unprecedented delivery rush. Over just 7 days, 33.45 million ounces of physical silver were withdrawn for delivery, representing roughly 26% of COMEX's registered inventory disappearing in a single week. This isn't normal market behavior, this is a structural fracture happening in real time. On January 7th alone, holders of 1,624 January contracts demanded delivery of 8.1 million ounces, with JP Morgan issuing 99% of those deliveries. What makes this truly alarming is that January is typically an inactive delivery month. Traders usually roll their contracts forward to active months like March, but something has changed. Buyers are now stepping into the futures market not for hedging, but for immediate physical delivery. They don't want to wait. They want metal in their possession right now. The current COMEX warehouse inventory stands at approximately 445 million ounces as of mid-January 2026. That might sound substantial until you examine the open interest, which represents potential future delivery obligations. The leverage ratio between paper claims and physical metal available for delivery has become dangerously stretched. Market observers note that a significant portion of what's reported as registered silver is either non-eligible or already encumbered in some way, meaning it's not truly available for immediate delivery. The pool of actually deliverable, fully eligible silver is much smaller than headline figures suggest. Silver prices have responded dramatically, breaking above $90 per ounce in January 2026 and setting new all-time highs. Citigroup has issued forecasts projecting silver could reach $100 by March 2026, potentially climbing to $110 by the second half of the year. This isn't speculative exuberance. This is institutional recognition of an acute physical shortage developing in the market. The dealer premium situation tells the same story from a different angle. Premiums represent the amount above spot price that dealers charge to cover their costs and profit margins. When premiums expand significantly, it signals physical tightness in the market. Current data from major bullion dealers shows American Silver Eagles trading at premiums of approximately $6 to $7 over spot price, when normal premiums range from $3 to $4. Generic silver rounds are showing premiums of $3.80 to $4.50 over spot, compared to normal levels of $1.50 to $2.50. These elevated premiums indicate that wholesale suppliers are facing delays and dealers are paying more to acquire inventory. The premium expansion isn't isolated to one dealer or one product type. It's systemic across the entire physical silver market, suggesting genuine supply constraints rather than temporary logistical issues. The geopolitical dimension adds another layer of complexity to this crisis. Greenland has emerged as a focal point in what some analysts are calling the Arctic resource race. The autonomous Danish territory holds an estimated 1.5 million tons of rare earth reserves, ranking 8th globally, along with significant deposits of silver, copper, zinc, gold, and other strategic minerals. Recent developments show the United States actively engaging with Greenland on critical minerals partnerships, partly to counter Chinese influence in the region. China has attempted investments in Greenland's airports, mining projects, and infrastructure, viewing the island as part of its broader Polar Silk Road strategy. The Trump administration's renewed interest in Greenland, framed around national security and economic concerns, reflects recognition that critical mineral deposits are becoming geopolitical chess pieces. The challenge is that Greenland's harsh Arctic climate makes mining extremely difficult and expensive. Most exploration sites are accessible only by helicopter. Mining operations would need to build their own power generation, port infrastructure, and transportation networks from scratch. The Russian factor cannot be ignored in this equation. Russia controls 53% of the Arctic coastline and has militarized 6 Arctic port facilities since 2024. Moscow views Western activity in the Arctic as threatening Russian interests. The Northern Sea Route, which Russia now dominates, could cut Asia-Europe transport costs by 40%, making it strategically vital for global trade. Russian palladium and platinum group metals, often mined alongside silver as byproducts, are now subject to expanding Western sanctions. Alternative supply routes through contested Arctic waters create massive insurance and logistics premiums. If geopolitical tensions escalate and Russian mineral exports become further restricted, that represents another pressure point on global silver supply. The Svalbard archipelago, though governed by Norway, maintains Russian mining presence. Despite diminishing coal reserves, Russia seeks to maintain its foothold for political positioning. Norwegian intelligence services have warned of Russia's nuclear deterrent in Arctic waters, indicating the region's growing strategic military significance. China's Arctic strategy deserves careful examination. Beijing's 2018 Arctic Policy White Paper described China as a near-Arctic state, arguing that events in the Arctic Circle affect China's climate, economy, and society. Chinese state-backed entities have filed exploratory permits in Greenland for polymetallic deposits where silver is extracted alongside rare earth elements. The Kvanefjeld deposit, supposedly containing the world's second-largest rare earth oxides reserves and sixth-largest uranium reserves, was being developed by Greenland Minerals, which is partly owned by Chinese group Shenghe Resources. However, Greenland's parliament passed legislation in 2021 prohibiting uranium exploration and limiting uranium content in mined resources, effectively halting development at Kvanefjeld due to uranium presence. Greenland Minerals is now suing the Greenland government for $11 billion, potentially creating a chilling effect on future mining investments. This political uncertainty around Arctic resource development means projected silver supply from these regions remains highly speculative and unlikely to materialize in the near term. The industrial demand picture reveals why supply constraints are becoming so acute. Solar photovoltaic technology has emerged as the single largest and fastest growing application of silver demand. In 2014, solar consumed only 11% of industrial silver demand. By 2024, that figure reached 29%. Each photovoltaic panel requires 15 to 25 grams of silver paste for the conductive layer that captures and transports electrons generated by sunlight. Global solar installations are projected to reach 450 to 500 gigawatts annually by 2030, potentially requiring 250 million ounces of silver per year from this sector alone. The European Union aims to deliver at least 700 gigawatts of solar capacity by 2030 as part of its Green Deal emissions reduction targets. India's production-linked incentive scheme aims to add 25 gigawatts of solar module manufacturing capacity by 2026. These aren't aspirational goals. These are active government policies backed by substantial financial commitments, driving real-world silver consumption. The electric vehicle revolution is accelerating silver demand in ways most investors underestimate. Traditional internal combustion engine vehicles contain approximately 15 to 28 grams of silver in electrical contacts and circuitry. Hybrid electric vehicles use 18 to 34 grams. Battery electric vehicles require 25 to 50 grams of silver, nearly double the amount of conventional cars. The Silver Institute forecasts global automotive silver demand will increase at a compound annual growth rate of 3.4% between 2025 and 2031. Electric vehicles will overtake internal combustion engines as the primary source of automotive silver demand by 2027 and account for 59% of the automotive market by 2031. Beyond the vehicles themselves, electrifying transportation requires massive expansion of charging infrastructure, which is itself silver intensive. Every charging station, every upgraded power grid component, every electrical contact in this vast network requires silver. U.S. infrastructure bills allocate billions toward expanding EV charging networks and upgrading electrical grids, translating directly into sustained industrial silver consumption. Data centers and artificial intelligence infrastructure represent an emerging and rapidly growing source of silver demand that many market analysts are only beginning to quantify. Data centers provide the physical infrastructure needed to run cloud computing services, store and manage data, and increasingly power AI systems. Global information technology power capacity increased approximately 53 times from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. Data center electricity consumption is approaching 1,000 terawatt hours annually by 2026, representing 3 to 5% of global electricity demand. Each server, each cooling system, each electrical component in these facilities relies on silver's superior electrical and thermal conductivity properties. The expansion of AI applications into media production, design, simulation, and other domains is driving exponential growth in server processing power requirements. Governments worldwide are prioritizing data centers as critical infrastructure, rolling out policies that provide grants, tax breaks, and fast-track approvals to attract large-scale private investment. The supply side of the silver equation reveals why meeting this surging demand is structurally impossible under current production systems. Approximately 72% of silver is produced as a byproduct of mining other metals, primarily copper, lead, zinc, and gold. This means silver mine production cannot easily respond to price signals the way primary commodity mining can. When copper prices are low, copper mines reduce production or close, which simultaneously reduces silver byproduct supply regardless of silver prices. Global silver mine supply has remained relatively flat at around 840 million ounces annually, despite silver reaching all-time high prices above $90 per ounce. The Silver Institute reported that industrial fabrication demand alone reached a record 680.5 million ounces in 2024, maintaining upward momentum through 2025. When you add investment demand, jewelry, silverware, and other uses, total demand exceeded 1.2 billion ounces in 2024. The market has recorded its fourth consecutive year of supply deficit, with analysts projecting a deficit of approximately 149 million ounces for 2025. The question of substitution deserves examination because industry advocates often claim silver can be replaced in various applications. Technically, this is partially true. Copper or aluminum can substitute for silver in some lower performance applications, but you lose 15 to 30% efficiency. In high-performance solar cells designed to maximize energy conversion, there is no viable substitute at current technology levels that maintains equivalent efficiency. The same applies to precision electronics, military-grade systems, and electromagnetic pulse-hardened defense components. Defense procurement represents another driver that rarely gets discussed publicly. The U.S. Geological Survey classified silver as a critical defense mineral in their January 2026 update. Military-grade electronics, EMP-hardened systems, satellite components, electronic warfare systems, and advanced guidance systems are all silver-intensive. U.S. defense procurement budgets for electronic warfare systems jumped 23% in the 2026 appropriations bill. That silver enters military stockpiles and government reserves. It does not return to the commercial market for recycling. The London Bullion Market Association and COMEX price discovery mechanism is showing signs of serious stress. For over 50 years, the global price of silver has been discovered in the futures markets of New York and London through paper trading. Physical metal changes hands based on these paper-derived spot prices. But when physical premiums diverge dramatically from paper spot prices, it suggests the price discovery mechanism is breaking down. Reports from January 2026 indicate that in some Asian trading hubs like Tokyo and Dubai, physical silver is reportedly changing hands at premiums as high as 80% over paper spot, with some transactions reaching $130 per ounce, while paper markets quote around $90. This represents an unprecedented two-tier market structure where paper prices and physical availability have completely detached. Industrial users in semiconductor manufacturing, electric vehicle production, and solar panel assembly are increasingly bypassing Western exchanges to secure physical metal at any cost, fearing total depletion of available inventories. The investor implications of this structural deficit are profound. Exchange-traded funds like SLV, the largest silver ETF, are experiencing sustained redemptions. SLV inventory dropped from 572 million ounces in October 2025 to 561 million ounces in January 2026, representing outflows of 11 million ounces in 3 months. When large institutional holders redeem shares, the fund must sell physical silver from its vaults to meet those redemptions. This removes metal from the system. The question investors should ask is where that physical silver is going. It's likely moving into private allocated storage, direct industrial use, or sovereign reserves, where it becomes unavailable to the broader market. Meanwhile, mining equity investors face a different calculation. Silver mining companies with producing mines in stable jurisdictions like Canada, Australia, and the United States stand to benefit enormously from sustained high prices. However, the vast majority of silver comes as byproduct from base metal mines, meaning pure silver producers are relatively rare. The timing of this crisis intersecting with broader macroeconomic instability creates potential for explosive price movements. Central banks globally have been accumulating gold reserves at the fastest pace in decades, adding 297 tons in year-to-date purchases through November 2025. Emerging market central banks are beginning to view silver not just as an industrial commodity, but as a monetary and strategic asset alongside gold. If several major central banks announce silver reserve accumulation programs, it would create sovereign-level competition for the same limited pool of physical metal that industries are already fighting over. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has compressed from extreme levels near 100 to 1 earlier in the decade to approximately 51 to 1 as of January 2026. Gold currently trades around $4,620 to $4,630 per ounce. If the ratio compressed further toward historical extremes of 15 to 1 or 20 to 1, silver would trade at $230 to $308 per ounce at current gold prices. China's recent policy shift adds another critical variable to this equation. On January 1, 2026, China, the world's largest refiner of silver, implemented strict new export licensing requirements. This move effectively ring-fenced nearly 65% of global refined silver supply for domestic use, leaving Western markets scrambling for remaining stocks. China's dominance in solar panel manufacturing means they require massive quantities of silver for their own production. By restricting exports, China ensures domestic supply security for its industrial base, while potentially creating severe shortages in Western markets. This follows a pattern seen with rare earth elements, where China leveraged its processing dominance to control global supply chains. The strategic implications are clear. Silver is transitioning from a globally fungible commodity to a regionally controlled strategic resource. Markets that lose access to Chinese refined silver will need to develop alternative refining capacity quickly or face persistent shortages and price premiums. The recycling narrative deserves scrutiny because some analysts point to increased recycling as a potential solution to supply deficits. Silver recycling currently provides approximately 200 million ounces annually, primarily from jewelry, photography, and electronics. However, solar panels installed over the past decade are only beginning to reach end-of-life recycling stages. The silver contained in these panels is technically recoverable, but the economics and logistics of collection and processing remain challenging. Unlike gold jewelry, which consumers actively sell when prices rise, silver embedded in electronic devices and solar panels requires systematic collection infrastructure and specialized processing. Most electronic waste currently goes to landfills or informal recycling sectors that don't recover silver efficiently. Even aggressive assumptions about expanded recycling programs suggest recovery rates might increase from current levels to perhaps 250 to 300 million ounces annually by 2030. That still leaves a massive gap between projected demand of 1.4 to 1.6 billion ounces and combined mine plus recycled supply of perhaps 1.1 billion ounces. The financial system fragility around silver derivatives creates systemic risk that few market participants fully appreciate. COMEX open interest representing potential future delivery obligations stands at approximately 186,000 contracts, with each contract representing 5,000 ounces. That's theoretical delivery demand for 930 million ounces against registered inventory of approximately 28 million ounces available for delivery. The leverage ratio of 33 to 1 means the exchange operates on the assumption that only a tiny fraction of contracts will ever stand for delivery. Most settle in cash. But what happens when this assumption fails? In March 2020, during early COVID pandemic disruption, COMEX silver spreads blew out to $7 to $8 over London spot, as the physical delivery mechanism experienced stress. If industrial buyers or large investors decide to demand physical delivery on even 10% of open interest, COMEX would face a delivery default scenario requiring either cash settlement at massive premiums or exchange rule changes allowing cash-only settlements. The political dimension cannot be separated from the market dynamics. President Trump's statements about Greenland being an absolute necessity for U.S. economic and national security reasons reflect recognition that critical mineral access is becoming a geopolitical imperative. Canada has sought to ramp up Arctic investment as part of a strategy to unlock resource potential, particularly amid strained diplomatic ties with the United States. Russia has lauded construction of new nuclear-powered icebreaker ships to navigate Arctic waters, calling it important for maintaining strategic presence. These are not coincidental developments. Major powers are positioning for a future where critical mineral access determines technological leadership and economic resilience. Silver's classification as a critical defense mineral by the U.S. government signals that market forces alone will not govern supply allocation. Strategic stockpiling, export restrictions, and preferential allocation to domestic industries become policy tools when resources are deemed nationally strategic. Investors who think of silver purely as a commodity traded on open markets may be missing this fundamental shift. The convergence scenario that should concern everyone is when multiple crisis points hit simultaneously. Imagine Arctic geopolitical tensions escalate, disrupting projected future supply from Greenland and Russian regions. Simultaneously, COMEX faces a delivery squeeze as industrial buyers demand physical metal. At the same time, a broader currency confidence crisis drives retail investment demand for physical precious metals globally. In this scenario, paper spot prices become meaningless because physical metal simply isn't available at those prices. Premiums detach completely, with buyers paying $40, $50, or $60 over spot just to obtain metal. This isn't theoretical. It happened briefly in localized markets in March 2020. It's happening right now in certain Asian markets where physical trades at massive premiums to paper. The question is whether this spreads to become the global norm. If it does, anyone holding paper claims to silver through unallocated accounts, futures contracts, or insufficiently backed ETFs will discover their positions can be cash settled at paper prices while physical holders name their own terms. The practical implications for different types of silver holders vary significantly. Physical stackers who own coins, rounds, and small bars in their possession are holding the most valuable form of silver in a shortage scenario because they have actual metal, not a promise to deliver metal. The premium paid today above spot price represents insurance against tomorrow's unavailability. A $6 premium looks expensive until physical is trading $20 over spot and sold out everywhere. High liquidity products like government-issued coins from the U.S. Mint, Royal Canadian Mint, and Austrian Mint will maintain their premium value and tradability. Numismatic coins with collectible value face different dynamics and generally should be avoided by investors focused on metal content rather than collectability. Allocated physical silver funds like PSLV, where each share represents specific identified bars in a vault, offer exposure to physical metal without personal storage concerns. These differ fundamentally from unallocated funds or futures-based products that can be cash settled. The reality that most investors need to accept is that markets can remain irrational longer than individuals can stay solvent, as the famous Keynes quote reminds us. Silver could trade sideways for months despite these structural deficits if paper market manipulation or regulatory intervention suppresses prices temporarily. However, structural supply deficits don't resolve themselves. The geopolitical Arctic chess game plays out over 2 to 5 year timescales. Industrial demand growth from solar, EVs, and data centers is locked in by government policies and infrastructure investments already committed. The COMEX inventory decline is observable and verifiable in real time through public data. These aren't speculative predictions. These are measurable trends currently in motion. The smart approach is to establish positions while physical metal is still available at reasonable premiums, understanding that the opportunity to acquire metal at any price may not last indefinitely. Critical indicators to monitor on a weekly basis include COMEX registered inventory, which becomes truly critical if it falls below 25 million ounces. Retail dealer premiums sustained above $8 over spot would signal acute supply crisis. SLV inventory declining below 540 million ounces would indicate accelerating institutional exit. USGS monthly mineral updates should be monitored for any changes to critical designation status or supply chain warnings. The spread between paper spot prices and physical transaction prices in various global markets tells the real story of supply availability. Lease rates for silver, which represent the cost to borrow physical metal, tend to spike when metal becomes scarce. Rising lease rates indicate institutions and market makers are struggling to obtain physical silver to meet delivery obligations. Each of these indicators is publicly available and can be tracked by individual investors to make informed decisions about timing and position sizing. The bottom line that cuts through all the analysis is this: when physical silver becomes genuinely scarce in a way that disrupts industrial supply chains and investment demand simultaneously, the price discovery mechanism will reset violently higher. Those who secured physical metal beforehand will be holding an asset that's in desperate demand. Those who waited will be competing against industrial giants, sovereign nations, and panicked investors for whatever scraps remain available. The difference between being early and being late on this trade is not measured in percentage returns. It's measured in whether you can access the asset at all. The Arctic Silver War is not coming. It's already here. The COMEX squeeze is not theoretical. It's happening in slow motion right now. The industrial demand surge is not speculative. It's locked into solar, EV, and data center infrastructure that's already under construction. The only question that matters is whether you'll position yourself accordingly while the opportunity still exists.